In this video, I'm going to show you how we can take the principles of index fund investing one step further to achieve higher returns. In fact, as you can see here, this style of investing has proven to outperform the stock market by quite some margin. Okay, so let me get straight into it. This strategy is called factor investing.
That's all the rage in the ETF business, and that's factor investing.
This approach builds on the evidence and data that make index fund investing so effective to find smarter ways to create index funds.
This is simply building portfolios using indexes based on something other than market capitalization,
giving you access to parts of the market known for better returns. For years, active managers used teams of analysts to find stocks that seemed more likely to outperform. And as an investor, you had to pay a lot in fees to access that thinking. Many of the trades that active managers have looked for, like buying underpriced quality stocks, are called factors. The basic idea behind factor investing is that stocks with some sort of shared characteristic or factor tend to produce higher returns over the long term. There are 5 factors that have historically proven to be drivers of return. There's quality, which identifies companies with strong and healthy balance sheets. This means low debt, stable earnings, consistent asset growth, and so on. Minimum volatility, or stocks that are less volatile than the broad market. Size, which targets smaller, more nimble companies. That's because historically portfolios consisting of small cap stocks exhibit greater returns than portfolios with just large cap stocks. Momentum, which seeks stocks on an upswing. The idea being that stocks which have outperformed in the past tend to exhibit strong returns going forward. And value, which targets stocks that are cheap relative to their fundamentals. Factor investing from a theoretical standpoint is designed to enhance diversification, generate above market returns, and manage risk. Portfolio diversification has long been a popular safety method, but the gains of diversification are lost if the chosen asset classes move in line with the broader market. The good news is that factor investing can offset potential risks by targeting broad, persistent, and long recognized drivers of return. Therefore, stocks that can be classified as one of these, it's argued to have historically produced better performance. And the idea is that the more exposure we have to these factors,
the value and the quality and the momentum and the minimum volatility,
the higher return we should expect. But how big are we talking? Well, if we take the size factor as an example, so small cap companies, we can see that in the US since 1971, small cap stocks have delivered substantially higher returns than the market. Another example is the value versus growth stocks. In the US since 1971, small cap value stocks have delivered a return that is 4 times larger than the large cap growth stocks. Therefore, you can clearly see that the outperformance is real and the returns are big. By that logic, if we're using a traditional index fund that tracks the market, we are leaving a lot of these additional returns on the table. This means that if we want to get higher returns, we should be allocating a proportion of our portfolios to these factors. So how do we do that? Before we talk about that, it's important to note that this style of investing may not be suitable for everyone, despite the fact that it could result in higher returns. We'll look at why that is later on, but first let's delve into how we can gain exposure to these factors. Given their track record of providing outsized returns, there has been an increase in the number of factor tracking ETFs over the past decade or more. There are ETFs that give you exposure to a single factor, or you can combine all of them through multi-factor ETFs. And you might be wondering which approach is the best. Should you just pick the one factor that's proven to deliver the highest returns, or combine them? Well, as you'd imagine, picking just one factor can be quite risky, because factor sensitivities can change over time. For example, over the past 10 years, the value factor has underperformed, surprising many investors, while the growth factor outperformed. There are many reasons for this. One key driver is that in periods of low economic growth, such as what we saw during the 2010s, investors will pay a premium for companies exhibiting growth. At the same time, what's interesting is how these factors interact with each other. Here we're looking at stock market data between 1990 to 2011 that compares various single factor strategies with the S&P 500. As you can see, over this period, each of these factor strategies outperformed the S&P 500. But if we combine them together into a single portfolio, we can see that not only does it deliver better returns than the market, but it's also less risky. Due to the broader macroeconomic environment, a single factor can experience sustained periods of underperformance. So investing in a single factor can be risky.
We think single factor multi-factor investing is very, very difficult. Very hard to time factors, very hard to pick which one is going to be in favor this year. When you combine 4 factors like the ones that we do, they actually have a very low, or even in most cases, very negatively correlated relationship to each other.
Therefore, the solution is to pick multi-factor ETFs, which incorporate all of them.
If you just use one of them, you can get an outperformance at certain times. And if you combine them all, you can get a certain outperformance.
As the name suggests, the multi-factor fund will have several buckets of stocks based on all 5 factors. So here are some examples of ETFs that you could look into. Before we move on to the next section, do me a huge favor and hit that subscribe button. It really does help small channels like mine. Thank you. First up is the iShares Edge MSCI World Multi-Factor ETF. This ETF tracks the MSCI World Diversified Multiple Factor Index. It uses the MSCI World Index as its parent index, which includes large and mid-cap stocks from across 23 developed markets, but it aims to maximize exposure to stocks that exhibit one of the 4 main factors: value, momentum, quality, and low size. Now, the downside with this fund is that its annual cost is quite high, at 0.50% per year. Next up is the JP Morgan Global Equity Multi-Factor ETF. This ETF uses the FTSE Developed Index as its basis. The index is then screened for stocks based on momentum, value, and quality, and each factor is equally weighted. This fund is much cheaper than the previous one at 0.20% per year. And here is a list of 5 other multi-factor ETFs that you can take a look at. And I will leave the link in the description box for you to access them. Despite the higher risk involved, some of you may want to target single factors.
The value and the quality.
So here is a list of some of the best ETFs. Now, if you wish to incorporate this style of investing into your existing portfolio without giving up your current traditional funds, you could follow a core satellite approach, whereby the majority of your portfolio, say 70 to 80%, could be invested in a global index fund, and the remaining 20 to 30% is invested in these factor ETFs to try to achieve higher returns. But the question is, given that it's proven to result in better returns than the market, why then isn't everyone factor investing? Well, it's important to note that these factors don't outperform consistently. In fact, they tend to fluctuate over time. For example, this table shows how often these factors have outperformed over different time periods. As you can see here, the stock market has performed favorably in 88% of the 5-year periods. In other words, investing in a traditional equity index fund beat bonds 88% of the time, smaller companies beat large companies 78% of the time, value beat growth 76% of the time, and so on. However, what this table highlights is that there is still a high chance of experiencing periods when these factors will underperform. Therefore, this strategy brings in more complexity and requires some emotional strength to stick with. So if you're going to follow it to target higher returns over the long term, you need to be prepared that you could underperform occasionally for extended periods of time. And unless you're convinced that this approach is right for you and it's implemented effectively, it's likely that you'll start to question whether factor investing as a strategy is still effective and end up giving up during these periods of underperformance and return to a traditional index fund instead, hence losing money in the process. The idea is that if you're absolutely certain that you can stick with this strategy during years of underperformance, then it may be something to consider. But otherwise, a traditional index fund is probably the sensible choice. In the end, simply holding the market has proven to beat 90% of active fund managers trying to outperform it. Plus, costs are very minimized, which works out in our favor. But the thing is that as good as these traditional index funds are in helping us invest and reach our financial goals, there is one thing that people get very wrong about the stock market. So watch this video next to learn about the biggest lie being told in investing and what you can do about it.